Welcome to the Chief Strategy Officer podcast. This podcast and Outthinkers Executive Peer Network provide a platform for the architects of corporate success, chief strategy officers, to collaborate and share their unique experiences in tackling complex challenges, navigating disruptive technologies, and driving impactful growth. In this episode, we sit down with Todd Cassler, Chief Growth Officer of Cerity Partners, to explore the growing role of corporate venture capital, or CVC, as a strategic tool for driving innovation and growth. With decades of experience in asset and wealth management as a Chief Strategy and Growth Officer, Todd is a trusted partner with a front row seat to how Fortune 500 companies are using CVC today, not just to diversify financially, but to shape their strategic futures. Things we're going to cover in this episode include why CVC programs often fail without CEO and board level buy-in, how to design a governance model that avoids being pulled back into business as usual, the hidden benefits that we often overlook of CVC, from M&A pipeline generation to competitive intelligence, what it takes to align siloed innovation efforts with core business objectives, how to measure the strategic and not just the financial value of your venture investments. Todd reminds us that innovation isn't just about deal flow. It's about mindset, metrics, and making the case for change. Whether you're just starting to explore CVC or looking to strengthen an existing program, this conversation is packed with practical insights. Let's dive in with Todd Cassler. Well, Todd, thank you so much for being here with us. Where are you joining us from right now?
I'm in New York City.
How long have you been in New York?
We're in New York just for business. I'm based in Boston most of the time, but I'm here probably 5 to 6 times over the course of the month. Our corporate headquarters is here, so it's always nice to get back to the city.
Got it. I just flew in from Boston this morning to Miami, and whenever I'm there, I eat as much lobster as I can. Do you still eat lobster?
Love lobster. Have you been to the North End and the Italian food there?
Yeah, no, I was not this time. I was in the Seaport District.
Great location. It's grown quite a bit.
So tell us a little bit about, we know your professional role, but tell us a little bit of how you got here. Were you born in Boston? And how did you decide that CVC was for you?
Yeah, so I grew up in Connecticut, so not too far from Boston. And, it's interesting. I didn't really want to be in financial services. And it's funny, 26 years later, having a long career and lots of success. When I was in college, I was interviewing with 2 companies. One was in private equity and the other was a big conglomerate. And the counselor said, "Hey, you should practice your interviewing skills." And it's funny, you go through your career, and at the beginning of your career, you really don't know how industry works. And so one of the things the private equity firm wanted me to do was to sign away all my ideas. And you and I both know that was actually their intellectual property. But I didn't know that. And I said, well, I don't want to give up all my ideas. And so I went and interviewed with this little financial services company in Shelton, Connecticut called American Scandia, which was subsequently acquired by Prudential. And so I got a job offer from the private equity firm and I got a job offer from the insurance company. And so because I didn't want to sign away my ideas, I said, well, I'll go try that insurance thing. And sure enough, went there.
What were you studying in college?
So I studied political science and economics.
Got it. I got it. Yeah. Yeah. Fascinating. We'll get into sales, I think, a little bit more. I think that's the worst advice I ever got was don't go into sales. And I wish I had. And that sounds like great that you got at least close to sales early on.
Yeah, I think sales is a great profession. And whether you're the CEO, the CTO, the CFO, I think selling is just a part of what we all do every day.
Gotcha. Yep. Bring us then from insurance into where you are now. And I think it'd be helpful for people, many people here listening will already be familiar, but just to kind of frame where CVC fits in the landscape. How do you categorize that versus private equity versus regular venture capital versus corporate growth, M&A?
Yeah. So, my career has always been in asset or wealth management. And so if you look at that, I've worked at very large companies, John Hancock and Manulife, Neuberger Berman. And then I transitioned to, the wealth management segment, working for Mariner and then, now with Cerity Partners. And so if you look at Cerity Partners, it's a integrated wealth management organization. It's about $130 billion. And we have a number of different things that we do for our clients. So we have a traditional wealth management business. We have an OCIO offering. We do private markets. And then we have a corporate venture capital group, which was formerly known as Touchdown. And so, what that group offers and provides is outsourced corporate venture capital management for Fortune 500 companies. And so, if you think about venture for hire, that's what this group created and has professionalized. And so, we're really unique in that we are providing the venture capital and innovation arm for large companies around the world, which I think is unique and differentiated versus most firms.
Yeah, and I think that you have this unique perspective in that you are serving. I mean, I don't know what the flow of funds are, but I imagine in any investment, you've got the corporation and you've got your financial investors. Financial investors are probably looking at this as an asset class that gives them a risk-adjusted return that fits in their portfolio. And the corporations hopefully are also looking for some strategic return. So first of all, what are the advantages of CVC beyond the financial return? Like, how can CVC help a corporation?
Yeah, well, I mean, I think you think about a company and they're really trying to solve for two things. One is innovation and the other is growth. And most companies don't have real clarity around what their growth is going to be in 5 years. And then if you look on the innovation side, just think about the life of a company in the S&P 500. 17 years, the CEO's life is about 7. A corporate executive is about 5.
Wow.
They're not being able to innovate and they're not being able to grow. And so when you think about corporate venture capital, what that is innovation and growth. And so, as a company thinks about that, a couple of things. One is they get the advantage of what's happening in the marketplace. They get the ability to see what their competitors are doing. They fill their pipeline with M&A. And lastly, they get to see market intelligence. And so corporate venture capital, while it can be an investment and you get a financial return, there's all of these other corporate benefits that come with it for a company and what they're trying to do in the future.
How often do you find that a corporation looks at corporate venture capital as that? Like, you're describing the strategic benefits of it, but just a little anecdotally, what I have often heard from innovation people is, I don't even know what the CVC people are doing. We don't talk. They're taking our capabilities and assets, wherever, just trying to make money from it, but it doesn't fit with our innovation priorities. I don't know if that's uncommon or.
Yeah, I mean, I think you have a couple different dynamics that are at play there. First is you have a company, and if you're a big company and you're large enough to have your own innovation program and your own venture capital program, it's not surprising that the groups will be siloed. And so, what the priorities are of the core business versus the growth business, even in a company that doesn't have a venture capital program, that there's some blurred lines there. So I think one is the innovation program, has to be integrated into the organization. The second thing is when you're designing an innovation program, what are you trying to design it for? Is it for your core business? Is it for growth? And then the last thing is are you standing up the right metrics to determine whether or not it's working? And I think your example is a pretty good indication that a lot of firms don't have those kind of internal frameworks built around, okay, why are we doing this? How is it going to help our business? And then lastly, how do we integrate it into our business? Unless you have those things, it's really not going to pay dividends.
So then how do you align? Who is it in the organization that needs to be involved, or kind of what are the keys to achieving that alignment?
Yeah, I mean, I think it starts at the top. I mean, if you go and you start with the CEO and the board, that's the starting point. And so you need to have alignment at the top that this is important. We're going to focus on innovation and we're going to make that a part of our DNA. I think the second is then pushing it down into the organization and doing some of the things that we talked about. All right, have you set up the program design the right way? What is the governance model going to look like? And then lastly, how are you going to measure that success? And when you're setting up the governance, I think one of the important things is you have to have a combination of both internal and external constituents on that governing body. And it has to be an arm's length away from the organization. Because if you don't, then what happens is, and you know this from a lot of your consulting work, is the gravity of the organization will just pull it back to the normal operating model. And so that innovation that you're trying to get becomes very challenging to have that move through the organization.
So what do you say to a core manager who maybe doesn't appreciate the risk of not having it be arm's length?
Yeah, I mean, I think there's a couple things. And, if you think about a startup organization or a firm that's innovating and you think about a large corporate entity, if you look at the large corporate entity, they start with a model of why it won't work. Whereas if you're starting with the entrepreneur and the innovator, they're doing everything to prove how it will and why it will work. And so, at the beginning of the framing, you have someone within the large company that's starting with, hey, I'm going to show how this isn't going to work, versus the innovator saying, hey, I'm proving to the world that this will work. You're starting with that kind of framework. I think the second thing is, in a large company, you have 30 people that can say no and not one that can say yes. And so when you talk about strategy for a large company, they're basically doing two things. One is a strategy to kind of deliver the existing product and to try to grow. Or the second thing is the strategy is designed to prevent a particular event from happening again. And 2008 was a great example. Companies put in place a strategy to ensure that they would not have a balance sheet issue from a financial crisis. And so then that strategy kind of continues through the organization, and it's very hard to change that. So I think it's some of those dynamics is, how do you convince people that this is an important part of the organization? This idea that it's not a why will it fail, but why would it succeed? And then probably the last thing is you have to set up safe zones to implement these kinds of programs, whether it's a sandbox or it's a beta test where you're giving it budget, where people are incentivized for them to be successful versus not having them succeed.
Oh, yeah. I mean, it's just hitting so many things. When I was in Boston, I was just sitting down with this gentleman, Andy Binns, who wrote a book about corporate explorers. And he works with Mike Tushman, and they introduced this idea of the ambidextrous organization and the mindsets that are so different between those ambidextrous organizations. And what you're describing completely resonates with what I've heard and what I see. I'm wondering, why do you think that is? My simplified answer, but I want to know if this is the answer. There's others, but is, we've got a business that's working. Your mindset is to protect that business and to avoid risk to the business. When you've got nothing, your goal is to create a business. So it's the pursuit, the explorer. Is that?
I think that's right. And you think about a large organization, the organization is designed around the ability to continue on, and you can replace each individual in the business will still operate efficiently and effectively. And you know this, you think about each role that the person has, it's a very defined role of responsibility and decision-making authority. There's a systematized process that if Todd leaves the organization, he can easily be replaced with somebody else and the organization continues and moves on. To your point, with the innovator doesn't have any of that structural framework. They're agile and they're nimble and they're very tactical in what they're doing. And so if you think about the intersection of those two entities coming together, they're at the opposite end of the spectrum on how they operate and think about getting things done. And so whether it's the frustration to move through the sales process, why is it taking so long to make a decision? Can't you see what the opportunity is in the future? And lastly, there's some protectionism in there. And so if you're the head of technology, is there an incentive or innovation, or pick whatever the category, is there an incentive to bring in a new technology that could either improve or replace some of the things that you're doing today? So you have all of those tensions that you're having to deal with.
Yeah, it's great. We're talking about there in that last part about the innovator's dilemma, but you're also saying that there are other entanglements as well. And one of them is that measurement of value, which I don't know if you could talk to that a little bit. Like, how do you show to the mothership that this CVC program is right, both from an ROI perspective, but also strategically? What are the metrics that you use?
Most people think about it from a financial return standpoint. Like, okay, I made this investment. Did the investment's value go up? And what was my return on investment? I think that's one part of it, but probably more important goes back to this idea of, okay, why did you make the investment? Was it for the purposes of your core business or was it growth? You then need to define, and you know this from your experience, you have to set up measurements to determine whether or not you're doing a good job and it's meeting the criteria, because anything that's not measured isn't important. And so especially in big companies where KPIs are significant, you have to set those things up and you have to manage them. But you look at things like, okay, did we actually have revenue growth, and how much revenue growth did we have in the term of millions? So if did we have millions of dollars of revenue increase? If it's on the core business, maybe it's did we have significant cost savings? But you're measuring, okay, what did this do for us? And did we improve our growth, or did we improve our efficiency? I think the second thing that you can look at is, all right, did it create a pipeline for M&A, and how many transactions did you do associated with that? Okay, we looked at 50 companies, we acquired 10 of them, and this is what it meant for our business. So those are two examples that you can look at, pure financial metrics. Or the second is did it improve our M&A pipeline and our deal flow, and how many transactions did we do?
And how does your CVC program contribute to your M&A pipeline, assuming that M&A is like acquisitions that are like tuck-ins and become core?
Yeah, so one of the benefits, speaking from our experiences, we're looking at thousands of companies. And so when we're sitting down with a client and we're there shoulder to shoulder with the management team and the organization, we know what their key priorities are because we've stood up a program for those purposes. And so as you're going through those companies and we're looking at all of those different organizations that are in a particular sector, we have a real view on a couple different things. What is the technology and what's coming? 2, what are your competitors doing? 3, how are these companies having an impact in the industry? And then 4, how would this relate to your individual business? And so, if you have that level of data, when it comes time to make an acquisition, you're really well informed on how it's going to make an impact. I think the other thing that's important, and is not necessarily talked about as much, is what is the commercial impact that the business is having, or you can have on the business by putting it into your ecosystem. And so if you're looking at a particular company in the venture program, and let's say you made an investment, you may already be activating the commercial value of that company through your ecosystem. And so then when it comes time to make a decision on do you acquire this, you have a really good view on the economics and what it will mean from a business standpoint.
Yeah, I can see that you have these multiple benefits in terms of sensing the trends in the environment, knowing what the technology is coming, feeding the M&A pipeline. But you serve very large companies. There's not one person. And so a lot of that benefit has to be propagated, like information has to be propagated. What are the mechanisms that you use to ensure that a company's benefiting from just the awareness and information?
Yeah, I mean, it's a great point on the information. And I'll give you an example. So one of our clients, we did a study in industrials and AI and what the impact would be for them in the sector. So we put in over 200 hours of research and work, talked to hundreds of companies, and put together very detailed information and case studies for them around what this means for them. This is what the industry is doing. And then how should they implement it going forward? Well, we're delivering that information to the executive committee, the board, the CEO, and we're really being leveraged across the organization for that intelligence. Now, this gets back to the structure that you referenced, having an investment committee, the governance model, having both the internal and external resources that are a part of that committee, and then meeting on a regular basis where you're talking about deal flow. Are we going to move this company through to due diligence? It's not just a singular entry point into the organization. It's touching all the different levels, but it really starts with the buy-in at the top. The CEO and the board is saying, look, innovation is important to us. We're going to make sure that that's a part of our fabric, and we're going to include it in everything that we do. And to your point earlier, a lot of companies say they have these programs and it's a nice to have, and it kind of sits off on its own, but nobody really knows what they're doing. I think that that's a big difference. If a company is really committed to it, they're making the financial investment, they're standing up the programs, they're applying budget to it, and they're integrating it into their process. I think that they do a much better job than just saying that we have an innovation program.
So maybe you could walk us through that contours of what a good investment committee structure, decision-making system is, because we get top leadership buy-in. Yes. CVC is important to us, not just for the ROI, but all the other reasons that we laid out. Where does it sit? Who's on the committee? Do they fund at the beginning of the year? Do they fund as needed? What do you think the best practices are?
Yeah, I mean, there's all kinds of different structures. You can have a hybrid model. You can obviously have an external model, an internal model. So there's all kinds of different ways that you can structure it. I would say that in our experience, a hybrid model is the best. It's a combination of both internal and external individuals. It starts with being really clear on the program design at the beginning. So once you get the buy-in from the top, it's okay, what is the program design going to look like? Where are you focused? Is it core or growth? And that's really the basis for how the program is going to be governed. And think about that like an IPS document. Like, this is our investment policy statement. This is what we're going to do. These are going to be the particular tenets of what we'll focus on. These are the expectations of committee members. This is how we're going to run the program. And so once you have that governance kind of framework really well established, then you're standing up, okay, what's the committee look like? How are you going to set up? Is it going to be arm's length? Is it going to be integrated? Our view is that it's arm's length, so it's separate. It's not integrated into the company. You do have members of the organization that are a part of that committee. And then when you're getting into what are they going to do on a regular basis, so the committee should meet monthly. In that committee, you both have internal and external individuals, and you are looking at individual deals, and you are making sure that that committee is following the governance framework that's been built. And we have real examples where we're in those committee meetings and someone from inside the company has said, well, we're not going to focus on that, or we don't want to do that. And we actually have to bring them back to that document and say, hey, our job here is to move companies through the process. Either we're going to do due diligence on it or we're going to pass. And so holding the corporate members accountable to what the purpose is of the group is key. The budget is typically set up as part of the normal fiscal cycle. And so if you're going to run these test programs and you're going to have beta tests and those things are being allocated, but that gives you a sense of all the different things. And then, lastly, we spent a little bit of time on it. You're reporting against it and you're having that feedback loop to say, okay, this is the value that you've gotten from the program. Here's the number of companies that you looked at. Here's what it's meant for you from an M&A standpoint. And if you're doing that, then you have a really good program that's, adding value to the organization.
I guess another lever that you kind of alluded to is also to what extent you're co-investing with other investors, how you're participating.
Yeah, I mean, that's, I think, a great point. And if you look at us, we'll look at 6,000 companies and we work with roughly 1,000 venture capital firms. Part of the benefit is to see all of the deal flow that's coming through. And one of the benefits that the company gets is they get access to all of that deal flow. And so part of the exercise is the conversations between different companies, different venture capital firms. What are you seeing? Here's what I have from a portfolio company. This is what my client's focused on. Oh, I have these 3 things that may be interesting for you. And so that network is just as important as, some of the structural things that we're talking about, because to your point, understanding where people are allocated and what they're buying or where they're investing, that's an important characteristic too.
Let's maybe just go a little bit deeper now into the core of the organization, because we have reporting, accountability, metrics, documents, right? But talk a little bit about the capabilities or cultural shifts that a company needs to make to really get the full value of a CVC program.
In these big companies, the organization is built and designed not around innovation and growth, but maintaining a particular direction and ensuring that the core business continues to move forward. And so this idea of, okay, we're going to add a new program, I think you have to win hearts and minds around why there's value in this. Okay, we're assuming that we already have stakeholder approval, but why is this important for the organization? Why is it important for our future success? And how is it going to help the individual? And so I think understanding those different stakeholders and who has different views and opinions, I think that's key. I think the second thing is, and we've seen this in examples where you have a lot of change in these organizations, and how do you manage that change? And one example is a company that had stood up a pilot program with an AI provider that was helping them in their customer service center. And the program actually generated millions of dollars of savings, better response times, and made a change within the organization. The new leadership comes in, and the first thing the person says is, well, I can build that myself. And as you might imagine, fast forward 18 months, still hasn't been built, still hasn't been able to achieve the success. And so I think that one of the things you find is there's always this initial assumption or assessment that, well, we can build that ourselves. We don't need an external company to help us with that project. So, how do you deal with that dynamic that suggests that this is additive, it's not punitive, and you can actually pull those kinds of things and get over the hurdle of, well, we can do it ourselves. So the cultural piece of it is really significant. I think the other thing that happens is going back to this 5-year kind of life of a C-suite executive, it becomes somebody else's problem. And so is it really a priority? Can I implement it? And a lot of it is okay, we'll let the next person solve for that issue. And so I think that's one of the other dynamics.
Yeah, I absolutely see this point about, hey, it's not my problem. I'm only going to be here for 5 years. I can just focus on Horizon 1 and 2 and let someone else worry about Horizon 2 and 3 later. Does it also work the other way? Because you've been very thoughtful in what you need to put in place in order for a CVC program to be successful and sustainable. And if this is just something that I'm only going to be here for 5 years, I might not put the time in to do it right. Do you see that as well?
Yeah, I think sometimes what happens is companies will have a focus, pick whatever the topic is, and they say, hey, we want to go in a particular direction. And so they need to stand up something, but it's not a priority. And so a venture capital program could be one of those items where it's like, hey, we want to focus on innovation. It's the topic that we're hearing from all the consultants. All right, we have one of those, check the box, but it's really not a priority. So the ability to put it on a presentation and say that we have an innovation program, yes, we're focused on that. We don't want to be the next Blockbuster or Kodak. And, it gives them the ability to check the box. But the reality is behind closed doors, it's not a priority.
Got it. Yes, I absolutely see that. So you primarily serve large organizations to help them establish well-structured venture capital programs that are going to last. In your estimate, order of magnitude, how many large enterprises have well-established CVC programs?
I would say, some of the largest companies have established programs and, are very prolific in their investment and are very well known. I would say then there's a handful that are trying to do it at some level, and then there's a bunch that are trying to figure it out. One of the biggest challenges for companies, especially in the environment that we're in today, is how they think about funding these things. And so, if you're running your own corporate venture capital program on a large scale, you're investing hundreds of millions of dollars in order to do that. And so if you're in an industry that's constrained or the market is volatile and your budget constrained, how do you put a program in place, or how do you get the intelligence in order to meet all the things that we've talked about here? Well, something like what we do, where you're outsourcing that and we can come in on a programmatic basis, can really help you, one, deal with innovation, and second, deal with growth. And you have the ability to scale into a larger program at some point in the future. So I think that depending upon the company and the size and what their budgets look like, there's lots of different variations and different ways to do it. One of the challenges is who makes those decisions and who's the most important person in the room to determine whether or not this is key for an organization. And I would say it's probably two individuals or two groups. First, it's the board. A lot of these discussions start with the board, and the board is saying, okay, we need innovation, we need growth. Where are we going to get that? And so it starts at the board level, talking about innovation and growth and where are we going to be in the future. The second then, obviously tied to that is the CEO. The CEO is thinking about, where am I going to get my growth? Where am I going to get my innovation from? And so the combination of those two are the starting point. And so once you have buy-in at the board and the CEO level, then you can push it down through the organization. I think very rarely does it come the other direction.
And what are the messages or fears or triggers that have a board say, now is the time? Is it the growth gap turbulence? Is it the erosion of the core, or the risk of the erosion of the core technology? What are the big reasons?
I think it's all of that. But I think the best example is the board doesn't want to wake up and be Blockbuster or Kodak. If you think about all of the changes and dynamics, and you obviously are at the front edge of this, just think about the impact AI is having on the workforce, business, what it will look like over the next 5 to 10 years. And what does that mean? All right, well, the board is trying to wrestle with all of those things on a regular basis, and they don't want to become irrelevant. I think the second piece is the CEO needs to grow the organization. And if you're a publicly traded company, obviously you got to return value to shareholders. And so how are you going to do that and remain relevant? Those are really the two biggest catalysts. And so every board and every CEO is talking about it and thinking about it every day. How do I grow my business? How do I stay, top of mind? How do I innovate and, come up with new products and things like that? I think the question becomes okay, where do you get your information and how do you execute upon that? And using a CVC program, is a really strong tool. And, we started at the beginning of the conversation. Yes, we're talking about venture, but at the end of the day, what we're really focused on is a tool to help with innovation and growth. And if you don't know where your growth is going to come from in the next 5 years, and you're not sure what the innovation looks like in your industry, well, this is a great way to get access to that intelligence to help the organization grow.
We've got the board on board. We got the CEO on board. Where do you see companies fail in implementing an effective CVC program beyond those?
Yeah, I think it's once it comes down into the organization. And so, if you think about the chain of command and the responsibility and authority, and as it moves further and further down into the organization, it becomes less and less relevant. So, you have to have a champion that's responsible for it. You have to have somebody that's engaged, at the executive level. I think it has to be something that's reported on at the executive level. And you have to be able to demonstrate that you're getting a return on investment. So those organizations that are clear and crisp on the role that it plays, have obviously done a really good job either managing their own or implementing it through organizations like ours. Those that don't think of it as a core program, they're the ones that struggle with it. And, they end up with, someone saying, just like you said at the beginning, hey, we got this venture group. I'm not sure what it does. I'm not sure how it's involved in the organization. That clearly tells you that it's not a priority when key members of the organization don't know what's happening. So it's pretty basic management 101. Okay, you're going to prioritize it. You're going to invest in it. You're going to report against it. You're going to have a key stakeholder responsible for it. And if you do those things, then, it will be a successful program.
Fascinating. Yeah, I mean, I knew about your work, and I guess I've always thought about it from the bottom, right? Creating the deal flow, doing the assessments, having the funnel and stages. And what I'm walking away from is that you're very much in like the change management transformation space. You're talking leadership, buy-in, you're talking stakeholders, you're talking organizational structure, you're talking culture. It is a multifaceted human puzzle.
That's exactly right. Multidimensional.
Todd, this was amazing. There's so many more questions that we can ask. We didn't talk a lot about the details of how you create the deal flow and manage that. You guys have so much experience in understanding the details of the structure. We could get into that, but this is the time that we have with you, and we really appreciate you taking the time to stop and share some of this with us.
I enjoyed the conversation and look forward to getting the piece.
Awesome. Thank you, Todd.
Thanks for listening to this episode of the Chief Strategy Officer Podcast. Thank you to our guest, Todd Cassler. Executive leaders who want to save time and resources or grow their network with like-minded peers can learn more about Outthinker's Executive Peer Network at outthinkernetwork.com. Until next time, let's keep the conversation going and rewrite the future of strategy together.